So auto loan delinquencies and repos are spiking right now. And Ally Financial just released their earnings. And I think it's very important for us to look into their earnings for the car market because they're one of the leading lenders in the auto space for the US. My wife's here today to throw up some charts. We're going to be talking about what all of these earnings, what these delinquencies mean for the car market going forward, and what it means really for the economy in general.
Net charge-offs increased 65% from year earlier to $456 million.
Yeah, so charge-offs, what that means is basically loans that they're writing off. They know that they're going to be losses. That's up 65% year over year. That is absolutely massive. And this is really happening across the market, right? Across all these banks. They know that they're going to have to increase their loan loss provisions because they're going to be losing a ton of money from these auto loans. And really, how they're going to lose this money is because when they go and repossess these cars, so many of these consumers have been so far underwater on these auto loans because they paid these ridiculous market adjustments 2 years ago. Last year, they paid all of these extra add-ons. They paid way over what these cars are worth, and now they're stopped. They can't pay for these loans anymore because the monthly payments are too much. They're getting these cars repossessed. These cars get sent to auction, and the bank cannot recover the amount that these consumers are underwater. So when that happens, the consumer is not going to be able to pay the difference on it. So the banks are going to take these big write-offs. Ally is showing that these write-offs they're just huge. They're 65% over what they were. That's a massive, massive number. And this is going to continue to get worse because we're entering this stage right now where, okay, these loans are now 2 years. They're a year past wherever these consumers actually paid way too much for these cars. Wholesale prices are coming down. So the gap in between what is still owed on these loans and what these cars are actually worth is just massive. And it's the consumer's fault for paying too much. It's the bank's fault for loaning too much. It's the dealer's fault for charging too much. It's everyone's fault in this matter. And the banks are going to get hit and these consumers are going to get hit.
Here is Ally's retail auto delinquencies data.
Yeah, so you can see that the trend is just continuously going up, and this is what we're talking about. That's so painful for a lot of these banks, is that this is going to continue to go up because rates aren't going down, and the economy is not getting any better anytime soon. And I really have a feeling for the rest of the banks that are going to be showing their delinquency rates in their earnings, their charts are going to look very, very similar to this.
This is the percentage of U.S. consumer balances moving from current to between 30 and 59 days delinquent during the quarter by loan type.
So you can see right here that the auto loan, the chart showing this big spike. You can go back and you can actually see on this chart where it happened in 2007, 2008, 2009, 2010, where there's a big spike too. And we are in the middle of this spike going up. And what we're seeing is that, there's this massive rise in auto loan delinquencies. But what's interesting is that month over month right now, auto loan defaults have pulled back just a little bit. And why that is interesting is because these two things should automatically correlate. There should be a massive spike in auto loan delinquencies, what we're seeing, and there shouldn't be any pullback in these defaults.
What's the difference between a default and a delinquency?
So delinquencies are when a consumer actually falls behind on their payments, and the default is when the bank has to basically take action. When the bank declares that this loan is now a loss and they're not going to try to work with the consumer anymore. So in the auto space, what that means is once the consumer defaults, the bank has said, you know what, we're not getting any more money from this customer. That's when they go and actually repossess the car. What I think is happening right now and why the defaults are pulling back a little bit are two reasons. The first reason is I believe that banks are actually trying to work a little bit more with consumers. They're trying to not put these consumers in default as quickly as they would have, because they know that the wholesale prices are going down. These banks, they pay attention to auctions just like us used car dealers do, and they know that the prices are going down. So they're keeping these loans on their books as long as they possibly can to try to get every little penny out of these consumers that they can, because they know that they're going to take these massive losses when they send them to auction. And yes, the consumer is going to be on the hook for whatever the deficit is from where these banks dump these cars at auctions versus what the consumer actually owes. But once these consumers go default on these loans, these banks really aren't going to get hardly anything out of these consumers because remember, they couldn't afford to make these monthly payments anyway. It's not like they just want to, they, in a lot of cases, they just choose to stop paying. It's that they can't. So if they can't make those payments, they also can't pay after the fact that they lose the car, that they owe this money back to the bank. So these banks, they're going to take massive losses on these. But the second reason is the one that I find most interesting and what is most troubling for our system and for the auto loan problem that we're dealing with right now, is that there aren't enough recovery drivers to actually get these vehicles back. And that's why you're not seeing these defaults actually take place, because the banks can't recover these cars because there are not enough drivers, there are not enough tow truck drivers, there are not enough recovery companies to actually go and pick up these cars. It's so bad right now that you have companies like Wells Fargo, you have companies like Toyota Financial that are actually paying extra money to these recovery companies to get pushed to the front of the line. And they're paying them $500 is what I think I read that Wells Fargo was doing. And this is on top of the regular rate that these recovery drivers would get paid to recover these cars. So when you're doing that, what Wells Fargo, what Toyota Financial is saying is that, you know what, we want to be on the front of the line. We want to get our cars back now because we know these wholesale prices are going down. And we know that there's a massive, massive, massive amount of these defaults coming through the system. So we need to get our cars back right now because the car market is getting worse. We need to try to salvage whatever money we can get out of these cars right now. And we need to pay extra to do that because there's hurt coming. And they know that. And that's just that they're paying these drivers extra money. That is absolutely screaming this right now. So another thing we're seeing from this report from Ally is that they're actually getting more strict on who they're actually lending to. So you can see this right here, that the average credit score of who is actually getting a loan through Ally has increased. Banks are tightening up across the board. And as the economy get worse, this number is going to continue to go up because they're taking risk off the table. And the way that banks take risk off the table is by not lending to more subprime borrowers. They gravitate more towards the higher credit scores. Consumer applications are actually going up, but the approval rate's going down. What that means is that even a bank like Ally is getting much tighter on their lending practices. They're having way more consumers that are actually trying to get into vehicles, and I'm hearing that from a lot of my buddies too that sell a lot of these higher end used vehicles, is that they're having a much harder time getting their clients in these loans. And what ends up happening is that a lot of these consumers, they're going to a lot of different dealerships and they're trying to get approved on a bunch of different cars because they're getting denied at a much higher rate. So that is going to increase the number of applications that a lot of these banks are seeing, because consumers are just going to keep trying and trying and trying and trying until they actually find a bank or find the right car, the right monthly payment to actually be able to get into one of these vehicles. So this is why you're seeing data like this coming through Ally, and it's a good thing for Ally to actually tighten up their lending practices a little bit. It's not good for the overall car market, because as banks get tighter, obviously less vehicles are going to get sold. All right, this chart is very interesting because you can see the 2021, 2022, and 2023, the mix of the type of borrowers that they're actually approving here at Ally. So in 2021, there's 24% that was your highest tier, then 26% in 2022, and now it's jumped all the way to 37%. So they're greatly tightening who they're actually wanting to lend to. And you see your lower tier borrowers, the ones that are more high risk, it's dropped from 21% 2 years ago to 14% now. and that's I mean, that's a dead giveaway of who they actually want to lend their money to, and what, and that they know that the economy is getting worse, because the people that are the subprime borrowers, they're going to be a much higher risk to actually default on these loans, and for the banks to actually have to take losses on a lot of these auto loans. So another thing that's actually interesting right here, you can see that even though the loan volume is coming down on this chart, the actual yield is going up. And the reason being is because interest rates are way higher, right? So they actually get more interest. They make more money on these loans because interest rates have gone up in such a meaningful way.
And on their list of tailwinds that they have coming includes portfolio yield continues to increase as older vintages are replaced with higher yielding new originations.
Yeah, this is something that's very interesting that that the banks see, and this is why a lot of investors, they'll say in a higher yield environment, you want to invest more into banks, and the reason being is because as these old loans come off of their books, these loans that were written 3-4 years ago, these loans were very low interest loans, so the banks are not making a ton of money off them. But now the new loans, the ones that they're originating right now, the interest rates are way higher, so the banks will actually make more money right now off these loans. So you have this natural attrition that's happening, where these old loans are getting paid off that are lower percentage, and they're replacing them with these newer loans that are they're much higher interest rate. So they're much better for these banks as far as the money that they're going to make for them. Now, the caveat for this is that for them to make this money, the consumers have to pay the loans off, right? So it's a much higher risk because the monthly payments are a lot higher. There's higher delinquencies, there's higher defaults, but also there's much higher reward because the banks are actually pulling in these extra percentages in the rates that they can charge because interest rates are so high. So here's the thing about these repos. So I'm a used car dealer, right? I get to go to these auctions, and I can see the amount of repos that are actually coming through the system. And what we're seeing right now is that, like Wells Fargo, Capital One, Ally, now these bigger banks, they're sending so many more of these repos through the system. So there's a bigger auction that I've been able to go to, and I've been able to talk to some of the people that work there. And what they're saying is that, okay, a year and a half ago, the same thing that I'm seeing is that these repos from these bigger banks, they just weren't there, so they weren't getting them in. And now they have lanes and lanes and lanes full of these repos. And just because we're seeing these numbers come through like Ally, we're seeing stuff come through Wells Fargo, this is really just the tip of the iceberg, because they're not going to actually make up a majority of the repos that are going to be pushed through the system. It's the subprime borrowers. And when I say subprime, I mean the subprime of the subprime that are actually going to be repoed at a higher rate. And those are these buy here, pay here dealers. And the reason why I say this data that we're seeing is just the tip of the iceberg is because Bob's Used Cars, all these small mom and pop shops that are buy here, pay here dealers, they're not having to report anything to any of these publicly traded companies. You're not going to see any of this data anywhere. When a customer becomes delinquent at from one of these buy here, pay here dealers, they immediately go into default, and the buy here, pay here dealer is going to go pick up that car, and it's going to immediately be repossessed and either put back on their lot or sent to auction. And because there's so many of these repos that are happening from these small buy here, pay here, mom and pop shops, that's going to pull even more strain on a lot of these tow truck drivers, a lot of these recovery companies. And that's why you see Wells Fargo, you see Toyota, that they're actually having to pay this extra money because they have to jump in front of these mom and pop shops that are repoing these cars now left and right. And I'm seeing that at a lot of these smaller auctions too, that some of these buy here, pay here dealers that were sending 6-10 cars a week to these auctions, now they're sending 20-30 cars a week to these auctions. That's a massive increase that's coming into the system of these repos. And it's just speaking to me of the scale of the problem that we're going through right now, because there's going to be a much bigger problem from these sub borrowers, from these mom and pop shops, from these buy here, pay here dealers, than we're going to see coming through the system from these bigger banks. And we have a mystery guest today. It's actually, well, if you're a mystery, I can't just announce.
Short-lived mystery.
It's a very short-lived mystery. think you need to talk louder.
What is the difference?
That's better.
It sounds like
Actually,
I'm angry.
do that. Yeah, that's funny. And you're in luck today because my wife is joining me. She's going to help me put up some charts on the screen for you. Nope.
What up?
I'm talking too long.
It does seem like an exaggeration.
Yeah. So, how do we say that you're
So
here?
what happens when you get no?
What is your
gain and you add
benefit?
in
What
no
is your
gain?
benefit here today?
You get more gain.
None benefit do you provide today. But you're here.
I'm really good at interrupting you.
You're really good at interrupting me. That's good.
It's fine.
That's fine. We're fine. Everyone's fine. We're
We're
fine.
fine.
We're fine.
Okay.
All right. Is that a good enough intro?
Probably.